got a question for you. Who are we? We're value creators. We're value hounds. We're looking for mispriced assets. We're looking to buy undervalued deals, right? That's what we're all about. We're looking for those inefficient market pricing opportunities. We're looking for mispriced assets. We're looking for gaps in value. How do you see value? We're going to be searching for those gaps, the value gaps that I talked about, because we are value hounds at heart and we are searching for those gaps. We're looking for gaps where we could pay, ideally anyways, 50 cents for a buck. 50 cents for a buck is what we're looking for to find those undervalued assets. And we're looking for those inefficient market pricing opportunities so that we can take advantage of those opportunities. We're looking for mispriced assets. I mean, that's ultimately what we're trying to do here, those undervalued assets. And there's a way that we go about it. But first, I want to talk to you about a great movie that was made a few years back. You see it right there. There's Brad Pitt. It's called MoneyBall. Did you see it? It was a great movie. And what I like about this movie, guys, is this movie's all about inefficient markets in Major League Baseball. And so I really think this movie is all about being a value hound because it's all about inefficient markets. So let me tell you a little bit about the movie, all right? So Moneyball was a movie that was released back in, I think it was sometime late 2011, roughly September 2011, I believe. And it really is a true story. It's a sports drama, and it was based on a book that was written by, you know that superstar writer, Michael Lewis? He's written a lot of great books. I don't know if you know. I mean, did you ever read the book Liar's Poker? That was a great book. It was about greed on Wall Street. He wrote another great book called The Big Short. That was back in, I think it was 2008. It was about the financial crisis that we had back in 2008. He actually wrote a book on it. And then probably one he's most popular for, other than Moneyball that we're going to talk about, is a movie called Blindsider. It was actually a book that he wrote. And that was with Sandra Bullock. And so the guy's a superstar, written a lot of great books, had some movies made about his books. And the one I want to talk about right now is Moneyball, because it really hits home to us as value hounds, as value creators. And the movie was all about the Oakland A's baseball team back in 2002 and how Billy Beane, the star, took a last place team and moved them into first place. And how he did that, the process he went through. And if you remember, the New York Yankees, they always seem to have the biggest payroll. And back in 2002, their payroll was $126 million. But the Oakland A's, their payroll is only $40 million. So how does this underfunded, outgunned A's team go from last place to first place and compete with the Yankees' $126 million payroll? How do they do that? Well, it's pretty simple, guys. They took the value hound approach. Yeah, the A's took the value hound approach. They basically ignored all the traditional recruiting techniques that was going on in baseball by taking advantage of more scientifical, more empirical gauges of players' performance. So they can actually win ball games. Instead of turning to the usual metrics in baseball, such as a pitcher's earned run average, they call that the ERA, or kind of going by the gut feel, Beane didn't do that. He didn't do that. What Beane did was he focused on a strong correlation, a strong relationship between on-base percentage and winning games, which pretty much threw out the subjectivity of getting players. He made it more scientifical. So you can see here, Beane's approach was pretty clear. Players with higher on-base percentage OBP made fewer outs. Fewer outs meant longer innings. And longer innings led to more runs, which, if you had more runs, it resulted in more wins. So that's how he recruited his players, who ultimately would score more runs. And if they scored more runs, they got more wins. So let's look back. What were Bean's results from this kind of unique strategy? Not unique to us, but unique to baseball. What was his results? Well, the Oakland A's finished first in the American League West with a record of 103 wins and 59 losses. And they also set an American League record on winning 20 consecutive games. In fact, the A's won the exact same number of games that the Yankees won. But here's the biggie. The Yankees spent $1.4 million per win, and the A's, they only paid $260,000. Wow, what a difference. So, recruiting talent is like buying properties. It's like buying properties. It's finding inefficient markets, finding value gaps, and playing Moneyball. We assess price versus value. To the A's, that meant finding players with qualities that were greatly undervalued by the market. I mean, for example, players who got on base as opposed to someone who just looked like a baseball player. In the A's, they purposely avoided those big-name players who ran fast, who hit 60 home runs, or whose face was plastered all over ESPN. Teams are always going to overpay for these big-ticket players that are plastered all over ESPN. All right, let's take a look at Alex Rodriguez here. I mean, you may have heard of him, right? You've seen his name plastered everywhere. Always seemed to have a new girl on his arm. Goes by the name of A-Rod. And you know what he does? He hits home runs and his face is all over ESPN. And as you look at his picture right there, you can see him a nice smile, plays for the New York Yankees. Let's take a look at his stats, right? You see the 2012 stats on the left part, and then on the right side, you see the results. So as you see that OBP, that's on-base percentage. That's what we're talking about Billy Beane looks for, is that on-base percentage. And his results in 2012 were 3.53. That was his on-base percentage. Now the next line down, the next category is BA. That's his batting average. He bats about 272. He plays in about 122 games. And his salary is $29 million. $29 million. Here's the guy that hits a lot of home runs and his face is all over ESPN. So let's take a look at a comparison. Let's compare A-Rod to somebody else. And let's take a look at Buster Posey, right? See him right there? He's the New York Giant guy. Nice looking smile as well. Let's take a look at his stats. His stats in 2012 were his on-base percentage was 4.08. So that's higher than A-Rod's. His batting average was 336. Again, higher than A-Rod's. The number of games he played in 148 games. Again, higher than A-Rod. Oh, check out his salary right there. $615,000. Buster makes $615,000 and A-Rod makes $29 million. What a huge difference. This is a comparison we're talking about, trying to find value, and you can see it right there. There's a huge difference in that value. So don't you think Buster's value is more than $615,000? I mean, gosh, you compare him right there to A-Rod. A-Rod's making $29 million. I think you can make a case for A-Rod's overpaid and Buster is underpaid. I don't know what the average salary is in baseball. It's probably in the $3 million range. His salary is $615,000. Isn't there a value opportunity there? Isn't there a value gap? Right? So, if you imagine these two players as assets, property assets, don't the same principles apply to us as value hounds? Aren't they really the same thing? I mean, we are looking for the same thing, guys. We're looking for those value gaps. value gaps. And the ability for us to find those undervalued assets and then convert them into cash, or in MoneyBall terms anyways, we call them wins. So ultimately, net value creation is our ability as real estate professionals, as syndicators, to create cash. That's our game. Those are our wins in the baseball league. So we're trying to create cash. And so what I want you to do is I want you to remember that as we go forward, your new favorite 4-letter word is CASH, cash. Well, how about this for value? Let's take a look at this comparison here, right? So what was a $10,000 investment in 1965 worth in the year 2005? So let's compare Berkshire Hathaway, and that's Warren Buffett's investment company, and let's compare Warren's company to the S&P 500. And if you don't know, this index is an average of the 500 largest companies on the stock market. The 500 largest companies. That's why it's called the S&P 500. So what we have here is we have Berkshire Hathaway. We have Warren's company worth $30 million in 2005. Wow. Warren took his investment from $10,000 in 1965 to $30 million in 2005. Wow, that's amazing. That's amazing. That's 3,000 times his original $10,000 investment. And by comparison, a $10,000 investment in the S&P would have only grown to about $500,000, or that's 50 times, right? 50 times. So Warren turned 10,000 into 30 million, and the stock market average turned $10,000 into $500,000. You think, gosh, dang, that's just amazing. And if you're like most, you're probably thinking, how the heck did he do that? How did he do that? Well, Warren has principles. And Warren only invests in companies that are 25% undervalued from the real or intrinsic value of the company. And you've heard me talk about intrinsic value, right? So we're going to talk about that going forward here, and I'm going to give you a little bit more information and a little more insight. But essentially, Warren plays MoneyBall. And here's Warren's definition of intrinsic value, and it's the discounted value of the amount of cash, remember that word cash, that can be taken out of a business during its remaining life. Cash that can be taken out of a business can come in two different ways. And as you can see right there, cash can be taken out of a business through cash flow and equity buildup. So Warren's approach is, if you can take all the cash a business is going to generate over a period of time, how much is that cash worth today? How much is that cash worth in today's dollars? So what Warren does is he essentially weighs all the cash over his expected holding period. He uses a cash flow and equity buildup scale. Kind of a similar concept to what you're going to see in this graphic right here. See it right there? And Warren says, price is what you pay. Value is what you get. Think about that for a second. It's pretty profound. Price is what you pay. Value is what you get. And so to get real value, Warren determines the intrinsic value. So how do we apply these same principles to real estate investing? How do we do that?